Today, we're going to focus on the different forms of legal enterprises. Okay, so there are different ways that individual entrepreneurs and groups of entrepreneurs can organize their business activity. Now, there's a list of different types of formal organizations. The first one, and most simple, is what we call a sole trader. This is where an individual will operate as themselves. So it could be small construction firms, gardeners, hairdressers. These are the most numerous form of business. Okay, they're small, normally individually run organizations. They might employ one or two people, but actually it tends to be people on their own. Okay, now as a business grows, it might decide that it wants to employ people, which they can do, but they retain as the sole trader 100% ownership of the business. Now, this brings with it certain advantages. Okay, it brings the advantage that profit is kept by the owner. They have full decision-making control. They can fit their own schedule in and around their days and weeks and months. There are some downsides, however. Number one, it is difficult to raise capital as a sole trader. That sole trader often has to use their own capital in order to start the business and maybe grow the business. And thirdly, maybe the most fundamental, is that you have what we call unlimited liability. Okay, we'll come on to that a bit later. But basically what it means is that when you invest money in a business, if you accrue debts, if you end up going out of business at the end if the business fails, the person that is running the business is liable for all the debts of the business. That means their personal possessions will be at risk. Okay, this is unlimited liability. Next, if a sole trader is growing its business and it decides that actually that person thinks, okay, what I'm going to do is I'm going to take on a partner. That means that you get two or more entrepreneurs or business people that join together to form a partnership. Now, there's a little bit of legal work to be done. So you have what's called a deed of partnership, and you have basically you've got to explain in a formal legal document what is the ownership of the business. So if it's 50-50 or 60-40 or 70-30, you have to explain what the roles and responsibilities of each partner are, and you have to explain how much capital they're going to put in, how much of the profit they're going to take. So there's some details that have to be registered, and they have to be put down in a formal document that's called a deed of partnership. If that deed of partnership is broken, then the partnership dissolves, it disappears. Including if one of those partners were to die, for example, then that business would be finished. Okay, that partnership is over. You can then form another partnership with somebody else, but that particular business is done and finished with. Now, this is a very popular form of business in things like solicitors firms, that's lawyers, dentists, doctors. Often you see partnerships that are being created. So individual partners group together to form a bigger business. Now, what does that do? Well, there's some really good advantages here, because number one, those partners bring capital. So you don't just rely on one person's capital, you are going to actually then have access to more capital within the business. Number two, individual partners may actually have a range of different skills that complement each other. Okay, so you might have somebody who's good at finance, someone who's good at marketing, someone who's good at sales, somebody who's good at production or something like that, right? So you've got a range of skills in the business that you can call upon. Next, you also have some downsides. So, for example, you're going to have to share profit, right? If you have a partnership, you don't get to keep all of those earnings. You don't get to keep all of those profits. You're actually going to have to share those profits with other people. And the other thing is, don't forget that actually having more people that are making decisions can sometimes lead to disagreements, can lead to long discussions, and people might not actually get on very well after a certain period of time. So you could have disputes within your partnership. And thirdly, and this is probably the biggest one, a little bit like sole traders, you have unlimited liability. And not only unlimited liability, but you have joint liability as well. What that means is you are not just responsible for your own debt, but you're responsible for all of your partner's debts as well. So if your partnership is running and functioning, but if it breaks down and there are debts to be paid, the partners are all liable for those debts. And again, the same concept, unlimited liability, means that your personal possessions can be at risk. Okay, so in that sense, a partnership can be quite risky. Some partnerships take out a form of insurance, if you like, which limits their liability. Okay, and these are called limited partnerships. It's to avoid the issues around joint liability and unlimited liability, so it protects your personal assets. So there is a possibility to create a slightly different form of partnership called a limited partnership. Okay, and that limits your liability for debt. Thirdly, as you are growing the business even more, what you might decide is to create a separation between the owners and the business. And this is where things get really interesting, because the business itself becomes a formal legal entity. Okay? You have to do more paperwork, you have to submit reports, you have to submit your annual reports for tax purposes. You do have to create two documents, one called a memorandum of association and one called the Articles of Association, which basically create the formal legal structure for the business. Okay, it talks about who's going to be the directors, it talks about what is the share ownership structure, and it allows you to understand which individual shareholders have access to how much of the business's ownership. It also talks about how dividends might be distributed. That's where you share out the profit at the end of the year. You may choose to keep it in the business, or you may choose to give it out to shareholders. Now, this is the biggest difference. You have separated ownership from the individuals. And that means the company can own assets itself, and it limits the liability. So if as a shareholder you put in a certain amount of money, you can't lose more than you have put in. You can only lose the capital that you have invested. And that's the biggest difference between having a company and having a sole trader or a partnership. Okay? So there are certain positives and there are certain negatives. Of course, the positives are you limit liability. You can get access to capital a lot easier. And the business doesn't die when the shareholders die. So you can pass those shares on to somebody else, or you can even sell them to somebody else when you choose to retire or you want to just leave the business. So it gives the business itself a legal entity in order to own assets. And that's a really important change from a sole trader or a partnership where you can't do that. Next, franchises. Now, franchising, you've probably heard of it because of companies like McDonald's or Burger King or Costa Coffee or anybody else. That if you think of a chain of fast food restaurants, then more than likely they're going to be a franchise, because it's a form of business that allows you to grow very quickly and be quite geographically spread out without having to invest a lot of money into the core business. So the idea is this: you have a concept for a business, you have one branch and it works. And what you want to do is you want to replicate that branch in another geographical location. So you sell the rights to that business to somebody else, and you allow them to open a business using your name, using your, let's say, uniforms, using your menus, using your ingredients, using your pricing strategy, using your marketing. And they will take an exact replica of your business and they will implant it in a slightly different geographical location. Okay? The most famous franchise ever is obviously McDonald's, who started doing this several decades ago in the 1960s. And that has become the biggest franchising operation that the world has ever seen. And that doesn't mean that McDonald's, the family of McDonald's, or the people that started at the Kroc brothers, it doesn't mean that they own every McDonald's in existence. Because what they've done is they've allowed other people to open a business in their name using the same formula, using the same format. Same menus, same uniforms, same decor, same ingredients, same ingredients. And McDonald's, the corporation, will even sell the raw materials to, or the ingredients to, the franchises. Okay, and in return, the franchisor gives profit back to the central office. Okay, obviously the central office has certain responsibilities like marketing, training, making sure that the public relations and the image of the company is upheld. And each individual franchisee, they have to pay a fee to begin with, and then they pay a certain percentage back to the central office for all of those things that they provide. Okay, it's a great way to grow a business quickly if you want to spread your geographical scope. Next, social enterprise. Social enterprises, these go against the general rule of businesses in the private sector, because what they do is they are not profit driven. Okay, profit is not their only aim. In fact, it's not really an aim at all. What they're aiming to do is they're aiming to provide a service to society. A good example of this is, a lot of you will be using Khan Academy, for example. Or you might have come across BBC Bite-Size Revision or things like that. And what that means is that actually that business has been created and set up with one single goal in mind. Not to make money, but to provide a service for people that need it free of charge. Okay, and that's really what we mean by a social enterprise. There's a few other social enterprises around. Things like cooperatives or mutual funds, where a group of people that have the same aim will all contribute something in order to make something better. So it might be a group of farmers that are all providing ingredients to a restaurant. That is then, the profits are then put back into their farms. Or it might be some form of environmental work that is taking place in the local area, where individuals from the community are simply doing something together in order to benefit the community that they live in. So you might have come across, I don't know, services for old people, or services for children, or daycare centres for children, for young children, for example. Next, lifestyle businesses. This is actually quite an unusual one. But what it's designed to do, it's designed to help somebody that has a certain lifestyle make that lifestyle into a business opportunity. So say, for example, I was an aficionado of golf, or I was a very enthusiastic skateboarder or skier. I might build a business around the thing that I love, around my hobby, around my lifestyle. So effectively what you're doing is you're saying, well, this is what I want to do with my time. I'm going to start a business that means that I can continue to do those things. So you often find this with leisure activities or sporting activities, that most people that are golf pros, or most people that are martial arts trainers, or most people that run a surf school, for example, will be surfers, or will be judo specialists, or will be avid golfers, because what they're doing is they're simply putting their lifestyle and making it into a business for themselves and others. Next, number 7, online businesses. Now, technically, this is not a form of legal business. All we're saying here is that actually, recently, over the past, say, 2 to 3 decades, some businesses have removed themselves from the physical environment, so that actually now you only have an online presence. And that's a different way of running a business. It's still a legal form of business. It will still have to be a private limited company, or a partnership, or a sole trader, or even a public limited company. But all we're saying here is that in some instances, the business has removed itself from the physical environment. So you don't have a shop, you don't have a retail outlet, you don't have a central office, you don't have warehouses. You are simply doing something that is an online business. So if you think about companies like Compare the Market, or Trivago, or Expedia, or companies that you might use, but actually you've never met anybody from that business or been to a place of business where they work, because there is no physical environment. This is happening at the moment with banking, right? So banking used to be a very personal thing. You used to go to a branch, speak to a person, you knew the bank manager, you had a relationship with that business. But now, if you imagine how many of you have actually been to a bank, met your banker personally, met your bank manager, very few, because all of that takes place online, right? All of that is in the World Wide Web, if you like. And lastly for today, we're going to look at public limited companies. Now, this we're going to focus on a little bit more than the others. These are from chapter 26 in your textbook for Business International A-Level. These will be in chapter 27 for your textbook for Business International A-Level. So, think about this. Once you have created a successful business, it has grown to a certain point, you may choose to go from a private limited company to a public limited company. Now, this is a big change. And the reason it's a big change is because in a private limited company, shares are held privately by a small group of people. Normally, your family, your friends, the people that have started the business with you. In a public limited company, you get access to a stock exchange, and any individual who chooses to can buy your shares. Okay, so there's a question about who controls the business. There's a question about who has access to your shares, and there's a question over how you split up your profit at the end of the year and who gets the majority of that profit. So a public limited company, or going public if you like, is where a private limited company will launch themselves onto the stock market, and then their shares will become available for anybody to trade. And this brings in a whole new area of advantages and disadvantages, because you can raise loads of capital. The owners can get super rich super quick. The value of the business can increase and decrease quite rapidly if the share price increases. There's also a danger of speculation, where people will buy your shares on the basis of news or information they hear about your company, which could artificially inflate the value of your company. The GameStop scenario, if you like, if you've heard of that organization, it was last year or a couple of years ago, the value of this company just shot up because of speculation from users on Reddit, and then suddenly crashed back down again. Lots of people a few people made a lot of money, and lots of people lost quite a lot of money. So there's the danger of speculation comes in as well. If you look at, for example, the value of a company like Tesla, it's currently trading at over $425 a share, whereas maybe 2 years ago it was trading at $100 a share. So there's this issue that the value of your company can change rapidly depending on what investors believe might happen in the future for your company. There are benefits, and the benefits mainly are that you are separating management and ownership. So the people that are running your company will not necessarily be the owners of your company. So they may take a much more objective view in terms of the best way to manage the organization. They're also likely to be highly skilled individuals because they're working for a large public limited company. So you tend to find that the best managers will be in public limited companies in what we might call the NASDAQ or the FTSE 100 or the Spanish, I think it's called the top 40 in Spain, or the relevant stock market for that country. So you've got one in Paris, Tokyo, you've got Sydney, you've got Amsterdam, and you've got London, of course, and New York. And those companies that are listed on that stock market will attract the best managers and the best people to work at their organizations. So there are positives and there are negatives. One of the biggest negatives is that it costs a significant amount of money to go public. Normally, a public listing, you would expect to spend somewhere close to £750,000 to £1 million just to get to the point where you are launching on the stock market. So it's not designed for small businesses, it's designed for quite big businesses once they've become established. Okay, sorry that video's gone a little bit too long. Please do enjoy and like and subscribe. Thank you. Bye.